How to invest for beginners. It's a very gloomy day outside, so I thought I'd make a video about something I get asked all the time. Whether you've got a few bucks to spare or you're ready to take the plunge, grab a notepad, make yourself a cup of tea or coffee. I've got mine here. And let's get right into it. Hi guys, my name is Susie. Welcome back to my channel. First things first, what is investing? Simply put, investing is put your money to work to make more money. It's like planting a tree. Today you plant a seed and over time it grows and bears fruits. That fruit is money. Robert Kiyosaki once said in his best-selling book, Rich Dad, Poor Dad, to achieve financial freedom, you must learn to make money work hard for you and not to work hard for your money. Now, why should you invest? To grow wealth and to outpace inflation. What is inflation? Inflation is when prices go up over time and things get more and more expensive. For example, an apple that costs $1 today, that dollar will only get you 3/4 of an apple in a year's time. You may ask, why can't I stash cash under my bed like my grandma used to? Or put money in a savings account? Firstly, definitely don't stash cash under your bed. Secondly, yes, savings accounts do pay interest, but here's the catch. Inflation in countries like the US, UK, Australia are anywhere between 3 to 4% at the moment. If your savings account also pays 3 to 4%, then your money isn't really growing. If you had to put money in a savings account, choose a high yield savings account that pays 5% or more at the minimum. Let's talk about different types of investment. There are stocks, bonds, real estate, gold, watches, designer bags, and exchange traded funds. The focus of this video is ETF or exchange traded funds. An ETF or exchange traded fund is a type of investment fund that holds a collection of stocks, bonds, and other assets. Plus, it's traded on a stock exchange like any other stock. Why are ETFs a great choice for beginners? Several reasons. Firstly, diversification. Instead of putting all your money in one company stock, say Apple, which can be risky, an ETF spreads your money across many different companies. This helps reduce risk because if some companies don't do well, others may do better, thus balancing things out. Secondly, lower cost. ETFs generally cost less than mutual funds. Mutual funds is where you have someone actively managing your investment portfolio and thus you pay their labor costs. ETFs in comparison have lower expense ratio, thus more of your money is invested at compounding interest rate. Thirdly, flexibility. ETFs can be bought and sold throughout the trading day, just like stocks. This flexibility allows you to react quickly if market changes. 4. Transparency. Most ETFs disclose their holdings, how much of the portfolio is invested into real estate, bond, cash, etc. So you always know what you're investing in. Now we know why ETFs are a great choice. Let's talk about how to get started. There are essentially 4 steps. Choose a broker, research ETFs, understand costs, place your order, and monitor your investment. Firstly, you need a brokerage account. This is where you buy and sell ETFs. Some popular options include Vanguard and Fidelity. The one I use is Self-Wealth. It's not sponsored, but Self-Wealth, if you want to reach out, please feel free. Secondly, look for brokers that offer a low flat fee. Whichever broker you choose, make sure it's a CHESS-sponsored broker. If you are in Australia, I cannot stress this one enough. That means the shares are legally registered under your name and not the broker's, thus reduce risk if the broker goes bankrupt. Secondly, make sure it charges a flat fee and no other hidden fees. If there's one thing you can take away from this video, keep fees low and grow your money long term. In Ramit Sathi's book, I Will Teach You to Be Rich, he explains a low 1% fee will eat into 27% of your investment return over the entire investment life. As an example, if you have $1 million investment, 1% fee means $270,000 of $1 million will be paid in fees. That's just crazy. Most people don't even have $270,000 in their retirement account. 2. Research ETFs. There are thousands of ETFs out there, so it's important that you do your research. Look for ETFs that match your investment goals. If you want to invest in technology-related companies, then you may want to look for a tech-focused ETF. Personally, I like to choose index that track the S&P 500. S&P 500 represent 500 largest companies in the US. These are brand names like Apple, Microsoft, Tesla. It's a good indicator of the overall US market, and they represent about 80% of the US stock market. If you choose an ETF that tracks the S&P 500, it means your portfolio is well diversified and less risky. It's very unlikely that all 500 companies will go bankrupt at the same time. If that happens, you have other things to worry about, and the money will be worth nothing, and you can just use money as toilet paper. 3. Understand the costs. Pay close attention to expense ratio, which is the annual fee charged by ETF. A lower expense ratio means more of your money is invested. A good expense ratio is between the range of 0.03 to 0.1%. 4. Place your order. Once you've chosen an ETF, it's time to buy, and it's very straightforward. All you need to do is to log into your brokerage account, choose the ETF ticker, decide how many you want to buy, and place your order. 5. Monitor your investment. After buying, keep an eye on your investment if you choose to do so. ETFs are generally good for long-term investing, so don't panic over short-term investments. You can review your portfolio periodically to make sure that aligns with your investment goals. And that's it. ETF really is a great way to start building your investment portfolio and creating long-term wealth. They offer diversification, low cost, and flexibility, making them a great choice for beginners. Because you've stayed all the way till the end, I've got some bonus tips for you. 1. You need to make sure you pay down your debt first. High interest debt like credit cards should be paid off before you even consider investing. 2. Emergency fund. People say leave aside 3 to 6 months, and some even leave aside 1 year for emergency fund, but that really depends on your personal circumstance. I would say start with leaving aside 3 to 6 months so you don't have to delay investing. 3. You need to max out your retirement account or superannuation if you're in Australia. 4. Mortgage versus investing. When I started off on my investment journey, I struggled to find answers to the question, should I put everything into my mortgage once I've paid down my interest? It depends on the interest rate. If I have 6% on my mortgage rate, investment return on my ETF is anywhere between 7 to 14 or even 20%, then it makes sense to invest into your ETF once you've met your minimum monthly mortgage repayment. 5. Timing. Generally, the earlier, the better. Let me give you an example. There's a really good website for this. I'll leave the link down below. It's called Money Cheap. Say you put aside $100 per week at age 20. You will have $600,000 at age 50. But if you increase that to $20 per week, and by age 50, you will have a staggering $6 million. Wow. Would $6 million be a handy sum at age 50 or even 60? Hell yes. To simplify things, there are only 4 numbers you need to know. Here it comes. 50% your fixed cost, 10% for investing, 10% for saving, and 30% for guilt-free spending. In Remit's book, he talks about treat yourself, and this is something that I can really resonate with. When I'm really strict, put down 50% to fixed costs and the remaining 50% to either investing or saving. Sooner or later, because I've been so strict, I will spend on things that I don't really need. Pause this video right now. No, I'm serious. Pause this video. Take out a piece of paper, and I guarantee this will fundamentally change your finances. Write down a fixed cost, investing, saving, and guilt-free money. How much roughly do you spend on each? Is this 50% fixed cost, 10% investing, 10% saving, and 30% guilt-free? I want to talk about fixed costs. These are things that you absolutely have to spend money on. Grocery, rent, utility, child's education expense. To me, the finding was astonishing. When I did my calculation, I literally spent so little on guilt-free spending, hence why I felt so deprived, as if there's no meaning to life. What's the point of working my butt off and not treating myself? There's a disconnect between making money and enjoyment of life. You might find something else. When you do your calculation, maybe you spent too much on guilt-free. Let me know down in the comment below what is your finding. Another bonus tip, only invest what you're willing to lose. And maybe $100 a month if that's what you're comfortable with. And don't try to flip shares for a quick buck. Compounding takes time. The earlier you start, the better. And there you have it, simple steps to get you started on your investment journey. Do a quick check of where your money is going and open a brokerage account today. Start with a small amount like $10 or $100 a month and increase as you get more comfortable. If you found this video helpful, give it a thumbs up and subscribe for more tips. Thanks for watching. Love you guys. I'll see you in my next video.